Everyone's been asking me, Corey, with everything that's just happened with the federal budget, should I even still be looking at buying property? Because shares looking even better than they were before, at least the government isn't changing the rules every 5 minutes. Should I shift my strategy? Should I move what I've saved into the stock market? Is property even worth it anymore? Since the negative gearing changes, capital gains tax changes, and the SMSF door getting shut? Or has the government just made that decision for me? Are shares now the smarter play? Some people today are saying property is done. Too many rule changes, too much uncertainty. Some are saying shares are the obvious winner right now, more liquid and less government interference. And honestly, sitting here with money ready to deploy, I get why that feels like it's a safer option. What should I do? Now, in this episode, I'm going to explain to you as to why the budget changes actually means nothing for property investors, true property investors. Not the headlines, the actual impact on your returns. I'm going to look at what the difference is between properties and shares and the way that the money flows. Then I'm going to show you what the data says about Australians building serious wealth in property and what it actually means. Because what people say on social media and what they're doing with their own portfolios are actually two different things. Here's what I've learned after years of doing this. Every time the government moves the goalposts on property, the noise gets louder. Everyone starts questioning. Everyone thinks the world's going to end. 6 to 12 months later, the investors who stayed the course with the right strategy in the right markets are far further ahead than everyone else who started to panic. Now, that doesn't mean that property is always the answer. It doesn't mean that shares are always the answer. It means that the question, property versus shares, is always the most wrong frame. The right question is, what's your goal? What's your timeline? And what's the vehicle that's going to get you there the fastest and the safest? I'm Corey Jones, and I've helped hundreds of everyday hardworking Aussies generate almost $100 million in the last 6 years alone. Now today we're going to settle this, property versus shares. What has the budget changed? Where is the smart money moving? And how to think about this decision for yourself without letting the noise get in the way. But firstly, to provide you guys a quick answer, property versus shares. In my view, both. They are both great. Any smart investor would have both of them in their portfolio. I want to make this clear. It's not about what you're investing in, guys. It's about how you invest in it. The how is so much more important than the what. Now, one thing that I'll say up front, budget or no budget, Australian property is by far, even still today in July of 2026, today, Australian residential property is by far one of the greatest vehicles for the average person to build wealth. And that has never been truer than it is today. Now, for those who are running around trying to sell the established property right now, or those trying to sell a property with a lease in place, yes, you're pretty bloody pessimistic right now, and I completely get that. However, this is just a right now thing while the market's still adjusting. In fact, I am so confident that property is still by far the best asset, and the simple reason is leverage. Now, this is one of the concepts that most people really struggle to get their head around, right? And I want to give you some context. Yes, shares do tend to grow at a higher rate than property. Now, obviously with higher rate means higher risk, right? So obviously the fact that shares are intangible, it does bring more of an inherent risk than, say, for example, gold or land. However, the average stock market on the ASX performs at a better rate than Australian property. That's true. The hidden key, though, is leverage. See, if you had $50,000 and you can only buy $50,000 worth of shares, which you could because you can't generate leverage for shares, even with someone experienced, the banks would give you a maximum of a 50% LVR. So even if you're an experienced stockbroker, all right, or share trader, you had $50,000, at maximum, the banks would allow you to borrow another 50 grand on top of that. So you've got $100,000 to play with. Now with property, you can actually go as high as 99% in one. That's in the most extreme cases. In many cases, you can go 95 and 5. In most cases, you can go 90-10. In almost in any case, you can go 80-20. Now this is called the loan to value ratio. Now let's play this out. If I've got $50,000 invested at stocks growing at 8% a year, that means that $50,000 growing at 8 is going to make me $4,000 a year. But if I invest that same $50,000 into my first investment property, let's just say my first home buy at $850, yes, I'm going to carry some debt. But if that property only grows at a 5% growth rate, so it grows less than what the shares do, because I've leveraged that $50,000 to an $850 property, I'm able to generate a return of $42,500 a year. So just notice, because I've been able to 10x my leverage over here, I'm quite literally making $42,500 versus making $4,000 over here. 10x the leverage, 10x the return. So just in that same scenario, by having the power of leverage, I'm quite literally multiplying my return even though I've got a lower growth rate. Now, the way to think about it, your wealth and your wealth projections are based on two numbers, the size of your portfolio and the rate of return. These are the two most important metrics when it comes to your wealth. Now, when you guys start playing around with this in your own time, you'll notice how quickly your wealth actually grows when you've got a much bigger portfolio, even though it doesn't grow at the same growth rate. Now, by using the power of leverage for property, you can essentially accumulate a far bigger asset up front even though it grows at a smaller growth rate. And yet you're still making a larger cash on cash return or ROI. Now, that's not even the best bit. The best bit is the fact that property is even more powerful because the banks will allow you to use your equity and leverage the growth to buy more assets. See, I can use equity from house number 1 to go buy me more shares at hundreds of thousands of dollars a year. I can use my equity from house number 2, go and pull out $500,000 and I can go buy businesses. I can use equity from house number 3 to start buying me more property. I can use equity from house number 4 to start buying me commodities or resources or gold or crypto. I can reuse the equity from house number 5 and start funding me my lifestyle, where it's very hard to go to the bank and say, hey bank, you see my $300,000 in shares over here or my $1 million in Bitcoin? I want to borrow money against my shares in Bitcoin. They will tell you to go away. Why? Because there's nothing actually tangible for the banks to secure the money against. They want to borrow money against land. So this, guys, is by far the most important factor when it comes to why property is a better growth asset or a better asset altogether than shares were for people starting to build out their portfolio. Now, this also goes without saying that Australian property grows at such a great rate considering most other international countries around the world. And that's mainly due to our immigration versus construction. We've also got a very safe, well-regulated and stable economy. Australian property is by far one of the best assets on the planet to build wealth with. And obviously, coupling that with the power of leverage, it gives you even more power. Now, without getting to the nitty-gritty of all the pros and cons of shares versus property, there is also one more fundamental underlying factor in property that no one else talks about. And that, guys, is the law of Ricardo's economic law of rent. Ricardo's law of economic rent simply states the wealthiest people in society are always the landowners. I'm going to say that one more time. The wealthiest people throughout society are always the landowners. Always. Now, here is why. When it comes to the economy, most of you guys know, if you've done high school economics, you would know that there are 4 factors of production. In other words, there are 4 things that actually generate any revenue that stimulates the market and creates some kind of income. Firstly, you've got land. That's the building or the asset that's required for the business to operate in. So right now, I'm doing this podcast in Balcatta. Our office is in Balcatta. We quite literally need an office premise and obviously a building in order to conduct our service. Now, some would argue, you could do everything digitally nowadays. Yeah, cool. We'll tell that to the fabricator down the road who needs a warehouse and lots of equipment. All right. The point is you need some kind of land in most cases for business. I obviously know in some cases nowadays, you don't need land because you can have businesses online. Fair enough. All power to you. But for most businesses, you still need some aspect of land. Now, secondly, the second factor of production is labor. That's the workers or the team within the business who can actually help the client and move the product forward. Thirdly, we've got the capital. That's the funding or the equipment required in order to fulfill the product or service. So again, if I use that example before of a fabricator, he needs welding machines. He needs, lots of equipment in terms of, steel fabrication. He needs laser cutters. There's a bunch of stuff. If you're a cabinet maker, there's lathes and saws and a bunch of things that you're going to need in terms of capital in order to get your product from raw wood into the final finished cabinet. The fourth and final factor of production is entrepreneurship. Now, entrepreneurship is the innovator or the risk taker who can put those 3 points together. So the land, labor, capital, entrepreneurship. Those are the 4 factors of production. Now, some would argue, and we've heard this a lot recently, that people who own property are evil because they're contributing nothing. All right. Some people would even have you believe that property is a right, or that property investors give nothing to society and all they're doing is basically, collecting all this money for no reason. I completely disagree with that. Owning a property means that you're the one who's putting your money at risk in order to provide land to that business. That is the first factor of production. Without that, you wouldn't have a business. By owning the building that the business is operating in, there are a few other things to consider when it comes to the power of property. Firstly, when you're buying that building, you are purchasing an inherent need: food, water, shelter. You are fundamentally providing that business or that person with shelter. You don't need shares to survive. You need food, water, and shelter. All right. So again, when it comes to property, say versus shares, the fact that it's a fundamental human need means that there is more of an inherent demand no matter what happens to the economy. Now, secondly, when that business signs a lease to go and rent that building from you, they start operating. The largest expense for any business is the cost of the premise, which means that you need to factor that cost into the business's overall viability. In other words, by you owning the property, you're technically making money based on whatever service or product that business actually ends up selling. So if a business was to come to you and say, hey, I want to lease your premise to operate my business, you've got to consider they've got to factor in your rent at the top of their cash flow. Because if they can't pay the rent, they've then got to move. They don't have a business. Now, what this means is if you have a business that sells guitars, for example, that means that you're quite literally making your revenue based on that business actually selling guitars. So you could argue that your income is actually diversified into the music industry as well. Thirdly, when that premise is paid for, it's paid for first in the business's cash flow. Because as soon as that business stops paying for the cost of the land, that business gets evicted and they've got to move. Which means that your payment, your rental payment, is actually factored in before the business is able to profit. Now, if the business ever lacks any money, the profit is what gets reduced, but the cost of the real estate is set. With this now in context, this is why the wealthiest people in society are the landowners, and the landowners are always the first to get paid when it comes to business viability. So when it comes to property versus shares, in my mind, you want to invest in both. I invest in property first for leverage and then reuse that equity over time to then reinvest into shares. And that's the way, guys. I'm getting the best of both worlds. I hope that helps.